Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, one of the most asked for guests on the site, Dr. Jim Willie. He has a Ph.D. in statistics from Carnegie Mellon University. Dr. Jim Willie, thank you for joining us today on USAWatchdog.com.
Well, thanks for having me back on.
I want to continue your intro here. You also are the publisher of the Hat Trick letter that can be found on goldenjackass.com, and you have been writing a lot about what the future looks like. I've been following you for years, and you've been pretty spot on, and that's what I want to lead off with. I have been getting so many conflicting views and hearing so many conflicting views from we're going to have a collapse in 2012. We didn't. We're going to have a collapse in 2013. I don't know if that's going to happen. Some people say, oh, no, that's not going to happen. Low percent chance, slow burn. Other people say that this is going to go on indefinitely. Other people say, don't know when it's going to happen, but the dollar's going to collapse. There's Jim Rogers, the famed investor Jim Rogers has been out recently, and he's been especially, he's been a little dodgy on exactly what's going to happen, but he thinks something big is going to happen, and he has gold and silver, and he's hoping to, position his families, just his family and his friends just before this happened. What is your view, near term and a little longer term, about what's your view of what's going on?
Well, I think in very plain terms. In my view, we had a systemic breakdown in 2007, and then we had a visible breakdown in 2008. And then there was the Lehman Brothers. '07 was the subprime mortgages. And then we had further breakdown in 2010 when Europe started to fracture. Then we got more breakdown in 2011 when QE was announced. Now we got further breakdown in 2013 with the gold market ambushes. So to say when's the breakdown going to happen, I usually have a sassy response to my clients. Where have you been? It's in progress. So what we've got is a lot of breakdowns in progress in a chain reaction leading to a climax. I don't denigrate guys like Rogers at all. Not at all. If he can't identify it, well, join the club. Neither can we. Neither can the best of the forecasters. We're leading to a big event. We got breakdowns in numerous structural elements of the financial system. You just take your pick. I could make a list 10 long. They're all breaking down. We don't know what the actual trigger's going to be, but I'm pointing to Deutsche Bank. I think Deutsche Bank is possibly going to be the one big bank they cannot control, and that's where you're going to get the big breakdown with contagion hitting numerous Western banks and hitting numerous important markets like sovereign bonds. So we're leading to a climax. We're getting a chain reaction of breakdown events. They're in progress.
Jim, I got to give you some credit here. About 3 weeks before Deutsche Bank got downgraded, along with Barclays Bank over in Europe and UK and in Germany, Deutsche Bank, and then Barclays in the UK, you were saying, hey, there are 3 banks that go to bed every night, something to the effect, that they're having a hard time opening their doors in the morning. Extraordinary measures are being done to keep them open, and one of them that you named was Deutsche Bank. And lo and behold, a few weeks later, it was downgraded along with Barclays. So your theme is there could be one big bank that starts this daisy chain of default around the globe.
Yeah, and Deutsche Bank is different. Notice that a year ago, Barclays was in trouble legally over LIBOR, but nothing happened. Well, they're very protected in London. Deutsche Bank's different. They may have been protected, but I call it the new sheriff in town. Something big is going on with a higher power, and that higher power enabled them to drain 5,000 tons of gold last March, April, May, and June out of London. 5,000 metric tons.
Wow.
The same force came down on Deutsche Bank, and they cannot stop what's happening. They're being revealed for financial fraud. This isn't just simple financial fraud. It was fraud for all the debt qualifications to join the European Monetary Union. They hid the Italian debt. They hid, concealed with fraud, the Greek and Italian debt. These are very serious violations. So now some powerful people who don't like the European Union and some powerful people who don't like to see the great protection of the London fortresses, they're going after Deutsche Bank as a weak link. And I think it's going to break it apart. But the most important thing to remember about Deutsche Bank is they're involved in everything. They're involved in all the sovereign bonds. They're involved in the Japanese bonds, UK gilts. They're involved in U.S. treasuries. And now their hands are tied because of prosecution. And I think half of their vice presidents have flipped and are cooperating with Interpol. You cannot man the desks in that environment.
So this leads us to the Treasury complex, and you've been banging the drum about that the U.S. Treasury is going to be, losing. They're going to be losing control of the U.S. Treasury bond, and there are a lot of dark forces out there that are wanting to go after these interest rate swaps and are tired of the suppressed interest rates, tired of the money printing that the U.S. is. Hey, we can buy oil and tennis shoes and consumer electronics with our printed money, and there's a lot of forces around the world say, no, this party is coming to an end.
I have two opinions on this, and I don't like to say, hey, look, I'm on both sides, therefore I'm not committing. I'm committing to the out of control, because I firmly believe we're seeing a chain reaction of breakdowns that is historic, that is of magnitudes never seen before on Earth in the modern era. But I'd like to point out the things that are holding it together, keeping it under control. But let's just start off with this live stress test that Bernanke conducted in late May and June. The press calls it the taper talk. Okay, that's fine. But what was it? Well, it was a stress test to find out what in the world would break down and collapse, with absent buyers and falling prices across the world in the major markets. And the answer was everything. Everything. Yeah. So the risk exposure breakdown toward collapse was seen as universal. Now we're seeing the Fed come out and say, well, we don't just have a dual mandate of price inflation and maximum employment, but we must now guard financial stability of the financial systems. Okay, like it wasn't important before? Like maybe what they're doing with QE has destabilized the entire world? Or better put, how about that the conclusion is slowly coming to be that the quantitative easing and debt monetization, the bond monetization, the Fed purchase programs and all that, QE and Operation Twist and whatever the hell they want to call it, how about they're creating a heroin addict on a financial table? Okay, that's what I think. I call the speech 2 weeks ago by Bernanke the Great Flinch. He blinked.
Oh, yes, he did.
He blinked big and the dollar fell hard. We also had carnage in the bond market the last week of June. Central banks sold $32.5 billion of Treasury bonds 1 week. And also global funds, I'm not talking U.S., I'm talking global funds, sold $23.5 billion worth of Treasury bonds. Inside the U.S., bond funds dumped $14.5 billion, setting a record, topping the previous week of $12.5 billion, which also was a record. Now, we've got a major liquidity crunch going on. Foreign governments are in great need of cash. They're selling their treasury bonds now to some extent for stimulus, for bailouts, for bond returns.
Let me back you up here on this. John Williams over at shadowstats.com came out recently, and you've been watching 80%, 90%. Now it's over 100. I think it's 103% of the treasury bonds have been bought by the Federal Reserve. So that kind of dovetails in with the information you're getting is that, okay, so if they're selling, who's the buyer? Looks like the Fed is the buyer of last resort. This is massive, over 100% monetization. I mean, nobody's buying. Everybody's selling. It looks like the Fed is forced to buy it all.
When the Fed sets up QE and then QE2 and then QE 168, I call it QE to infinity. I called it that 2 years ago.
You did.
When they had their first QE, I said, there'll be a QE2, there'll be a QE3. People were saying, oh, no, it's just temporary. No, I said in 2009 that the 0% is going to stand forever until the debt defaults. No, they said it's just 6 or 8 months. No, you need to, okay. What they did with all these bond monetization programs is to tell the world, hey, look, there are no buyers for this garbage. Bring it to our window. We'll buy it. They're the buyer of last resort. Their balance sheet at the Fed is over $3 trillion now.
Oh, yeah.
It's mostly toxic. And I believe there's going to be a restructure of the Federal Reserve when they resign. But let's look at some of the positive under control elements for the Fed and the Treasury bonds, because there's a big question. How come it hasn't broken down yet? How can they keep it going?
That's right. Everybody's asking that. Why? I mean, I've heard PhDs, you're one of them, and many PhDs, Paul Craig Roberts and other financial people, one of the universal quotes that I've gotten from people when I interview them, smart people, say, I'm surprised it hasn't broken down already. And I guess you're going to give us the answer why it hasn't broken down already.
It's amazing that some of these so-called PhD experts don't know what's going on. I pregnant pause there. I'm tired of the PhD economists. They're harlots. I'm tired of the promotional offices for Wall Street with their PhD economists. And I'm tired of the other people who claim to be experts in finance who don't know about the Exchange Stabilization Fund run by the Department of Treasury. It's the most powerful office in all of the world's finance. What they do is they have their fingers in every single financial market and every single financial instrument in the world. We're talking about $1 trillion office. They don't operate with spread trades. I've been educated a bit by my friend and colleague Rob Kirby. He's a very bright guy. He's got excellent experience in Toronto dealing with bonds, bond trading, derivatives tied to bonds. And I don't want to misspeak about what his other qualifications are. They're vast. All right. The bonds that are set up by the Exchange Stabilization Fund, I'm going to call it the ESF. The ESF sets up, they're not bond spreads. They go in there and they just march in and bang. They put on some big demand using leverage, using all kinds of instruments. Their futures contracts, their interest rate swaps, there are all kinds of things with phony demand tied to them. That's why, like I called in 2010 and 11, the great migration to bonds, they called it the flight to quality. There was no such thing. That was Morgan Stanley putting on $8.5 trillion of interest rate swaps. All right, so on the other side, you've got the counterparties, the bond dealers. They must scramble to purchase this staggering U.S. Treasury bond volume. It must be done in offset for the Department of Treasury's ESF. The Exchange Stabilization Fund is enormous in their volume. That explains some of the failures to deliver. Now, it wasn't exactly a joke. My harsh criticism 10 years ago was we first started to see failures to deliver. And then again in 2005, 6, and 7, it was because of counterfeit Treasury bonds that JPMorgan had written. They essentially had $2.3 trillion in counterfeited Treasury bonds. And all the evidence was in Building 7 at the World Trade Center. They went down from bullshit structural sympathy. Without any impact. All right, the Fed also relies on interest rate swaps, and Morgan Stanley is their standing harlot on Wall Street to execute them. They've got between 20-to-1 leverage and 50-to-1 leverage. It creates bogus demand. They've also got the forward rate agreements. I believe they're on the OTC, not certain about that, not sure where they are, but they help. The interest rate swaps and the forward rate agreements keep things under control. Not only that, but the Fed, with the Department of Treasury at their side, has the Internal Revenue Service. Don't ever forget the income stream from withholding on salaries. It's the payroll deduction withholdings. You probably have one yourself with your corporation. You pay weekly or monthly or bi-monthly into this. It's a tremendous stream. It works kind of like the mining firms with their stream of the gold and silver output. Well, the Department of Treasury has its income stream with the IRS and their tax funds. So the Fed has got all these different tools with the Treasury at their side, but they can't keep things under control. Notice that a year ago you had the London whale derivative accident. Now expect another London whale sighting. That was not about Forex derivatives and swaps. No, not at all. They claim that, but if you look at the 2 or 3 months prior to that, you'll see that those sovereign bonds were all doing very well. They were improving. No, it was about interest rate swaps because of the quickly moving Treasury bond yields, like for the 10-year.
So how is it going to get out of control, and what's it going to look like to the guy on the street? Because you're saying that there are multiple breakdowns going on. One of them is got to be city of Detroit. That's the canary in the coal mine that's lying on the floor dead. $9 billion in underfunded pensions. So what is the out of control going to look like? They're going to lose control. They've been keeping a lid on it. You just explained how with interest rate swaps and all this phony demand for the Treasury Department. How are they going to get out of control?
Okay. As preface, let me just finish off with a conclusion. I'm 30% in the camp of things under control, but I'm 70% in the camp, that's 2 for 1, that it's out of control. They're on QE to infinity. Why did they announce a QE3? Because nothing improved from QE, QE1, and Operation Twist. They call it stimulus, but it's not. That's the dirty secret that these clownish, idiotic PhD economists cannot grasp. They call it stimulus because it's 0%. In the past, it was stimulus because American corporations could go out, use the cheap money, do some capital investment, buy some equipment, buy a building, open up shop, hire people, but now they don't do that because China is on the scene. So the QE is a breakdown symptom. It's a collapse symptom. And now with this live stress test that proved that the whole system would collapse on 20 fronts, you name it, the Indian stock market, you name it, doesn't matter. They all fell apart. So now they've got political permission to do QE forever. That's not a sign of being under control. And what it points out is that whatever unintended consequence came or comes from QE will be exacerbated, and that is capital destruction. Again, what the clownish, idiotic PhD economists have overlooked. 0% plus bond monetization causes hedging in the market, purchase of hard assets, purchase of energy, purchase of metals, purchase of land, and driving up their prices. As a result, the cost structure rises, and the whole system must deal with lower profitability, cutting out businesses, trimming down, bankruptcies, shut down business segments, shut down businesses, and you get the liquidation of capital. That's what I call capital destruction that the PhD economists slept through in their PhD programs. The out of control has 3 very big elements. The big banks now for 3 years have been taking advantage of a very big treasury bond carry trade. They borrow 0%, they buy the long bonds 10 and 30 years, and they put on futures contracts.
More false demand.
It's false demand, but the important thing regarding out of control is with rising rates, they're losing money at a leveraged rate.
That's right.
So it's going to unwind it, and they even have a name for it in Wall Street, convexity, meaning that little increases in interest rates force big sales of the leveraged bonds, which bring about more doubled and tripled and 10 times as many sales. So guess who's going to have to lap that up on the ground? The Fed again. The second big force is that foreigners are selling treasury bonds out of disgust. They're not part of the decisions at the Fed. They don't get a decision on whether they go to QE3. They didn't like QE2. Operation Twist was different because that allowed the foreigners to say, we don't like these high-risk 10 and 30-year bonds. Let's swap them with your twist into the 3-month, 9-year, and 1-year, 2-year, so we can wait you idiots out, and we can redeem without selling. They'll just expire and mature. All right, but the foreigners are also disgusted, so they're using their treasury bonds in all kinds of different manner to pay off debts in acquisition. This has got a name also, not convexity like the leveraged abandonment of the carry trade, this is called indirect exchange. I'll give you an example. I think I mentioned this a couple months ago. Rosneft, which is now twice the size of ExxonMobil, bought out British Petroleum.
Yes.
And what do they pay these London bankers in on the payoff for the TNK BP big oil energy firm? And what do they pay them? In treasury bonds.
Paper.
When China pays Russia for their oil and gas coming in the pipelines, they do it in treasury bonds. When the buyer, here's one that's coming up right now, OGX from the Batista Empire in Brazil. It's an oil and gas business. Well, it went bust. Look for the Chinese to buy it up. What do you think they're going to use to pay for the acquisition? Treasury bonds. I called this a couple months ago return to sender. Treasury bonds return to sender. Because they're broken, they're toxic, and the foreigners don't have a voice. All right, these are very big things, but I really believe that the interest rate swap is the zinger, it's the live wire, it's the third rail. We get big changes in the 10-year. I just focus on the TNX, the 10-year Treasury. It's gone from 1.7 in May to 2.7 now.
Yeah.
Normally, 30 basis points is enough to disrupt interest rate swaps. Compare the treasury bonds to a giant tower. Like the Sears Tower is 110 stories. Think of a tower 200 stories, and because it's so high, it needs buttresses to support the side at, say, 50 stories, 80 stories, and 120. Those buttresses are the interest rate swap derivatives. They don't react well to high winds. I don't care if it's wind from the east or wind from the west. I don't care, therefore, that if it's rising interest rates or falling interest rates. It disrupts the interest rate swap derivative complex. And now the U.S. banks are more insolvent than ever, and they don't have the capital to defend these interest rate swaps. They have inadequate ammunition, and furthermore, the Swiss castle, leader of the world, Basel, the self-appointed Lord of the world, Basel, has instituted Basel III rules. They must have more capital. They must now bring to their balance sheet their derivatives. Why? Because Basel wants to collapse the system so they can impose banker fascism.
When do you think the collapse would come? What's your timeline?
I think that the 52nd day of September.
Ah, okay. Who knows? But when it blows, it's going to blow fast. It's going to go boom.
I will say this, and this is my semi-intelligent response after my flip. Take a look at the time between important events.
You've said this before. It's a very good point.
And they're getting shorter.
Yes.
Now we're getting bigger conflicts in other arenas, like the U.S. finance delegation might not show up at the Moscow September G20 International Economic Summit meeting. Why? Because of Snowden and the database security eavesdropping. So the United States might not attend a world summit? The United States already is really not invited to the G20s. And, some people think that the G7 slapped around the G20 in Ankara, Turkey in the beginning of June. This is just 2 months ago. Some people think that the G7 came in and said, hey, wait a minute, you can't do that. We're bigger than you. We're more powerful. No, they went to Ankara begging. They begged for a delay. And what was the agenda at that G20 in Turkey in the first week of June? It was the nuts and bolts of gold trade settlement, the dollar alternative, the non-dollar trade settlement system. What they compromised in June was, all right, we'll give you idiots in the G7, you powerless finance ministers from your sovereign bankrupt countries with your infinite monetization to bail out your banking system and your infinite deficits on the fiscal side. We'll give you till September, because in Moscow you ain't going to be invited. You try to crash that like you did in Ankara, you're not going to get through the door. You're not going to get through the airport. Putin is a son of a bitch. and he's now got an agenda. It's to bring about a dollar alternative. And a lot of naive people think, oh, the dollar's going to rule the waves forever. Well, the U.S. military just had a setback in Egypt. Is anybody paying attention? You know, I got some other news for you. There's some other people who are very misguided who think that the U.S. military still rules. Well, in Easter Sunday 2010, a bunch of Arab billionaires, a couple hundred of them, made a decision in 2010 that Russia and China would be the new protector in the Persian Gulf. There are other things. Why do we have saber-rattling about an Iran war in 2004 and 2005 and 06, 07, again in 08, again in 09, again in 10, again in 2011, again in 2012, but no Iran war? It's because the U.S. backed off. The Russians have the Sunburn and Onyx missiles, which are a generation ahead and far more accurate and deadly than the U.S.'s cruise missile, which is 25 years old. The U.S. backs down. It's not that the Russians and Chinese won't challenge. No, no, no. Just the opposite. We got a lot of things that are out of control. You know, back to Deutsche Bank for a second in these swaps. One thing that's coming out with Deutsche Bank is that they're Forex swaps, not interest rate swap. They're Forex, currency swaps. They treat gold like currency. Isn't that ironic? And you know, when that news gets out about the broken swaps with Deutsche Bank and maybe some liquidations have to happen, maybe they're going to have to liquidate some of their euro and British pound and dollar swaps in favor of gold. Maybe we're going to see $100 increases in the gold price in single days because these swaps have gigantic leverage. I mentioned once in a forum that it's 20-to-1 leverage, and Rob Kirby just smacked me down and said, Jim, try 50-to-1. Some of them are 100-to-1. All right, so they got leverage holding down gold, and they're breaking in Deutsche Bank's portfolio.
Let's get to the gold question here. I want to wrap up with the gold question because I've heard a lot of information, a lot of reports that are coming out, at least on the internet, about this massive amount of vault liquidation. Gold is leaving vaults. Gold is leaving, GLD. Silver is leaving SLV. JPMorgan vaults are getting hit. I mean, they're losing tremendous amounts in a single night. LBMA has, as you said, has lost a lot of gold. COMEX also. When are we going to get this failure to deliver? Or maybe I better put, I don't want to give you a specific date, is a failure to deliver, is a force majeure, we cannot or will not deliver physical silver or gold. When is that coming?
Well, I think it's already happening. Same answer. And it happened in April. In fact, it first happened with the MF Global incident I think it was right around December 1st of 2011. They didn't want to have a default because that was the next morning, a default. So they stole MF Global accounts. They didn't make the delivery for those silver. JPMorgan took the delivery for the silver. So we're seeing disguised defaults already. April was another gold default. ABN AMRO came out in late March and said we're not going to honor gold account redemptions. 2 weeks later, London has the ambush because they were facing a default. Why do we have the Mali war announced in northern Africa? It's because they can't meet the demand for repatriation. They already failed to deliver the German official account, the allocated account. So they need a war in 7 years. That's exactly what the gold output is in Mali to meet the 350 tons for Germany. But, more specifically to try not to be so evasive in the answer, again, we're getting more and more events happening closer and closer in the gold world. You've got now JPMorgan being recognized as having taken the July silver output from delivery in London. You're getting JPMorgan recognized as having its own clients, its registered clients, abandoning them in the vaults. You're now getting recognition. These are smoking guns. That the COMEX delivery in gold is matching the withdrawal from the back door out of GLD. You're getting high correlations of over 80% between the GLD withdrawals and the Shanghai premium paid in gold. They're rating GLD to cover COMEX deliveries and to deliver in Shanghai. I don't know when it's all going to go bust and everybody says, oh my gosh, look, we got just shutdowns here, lawsuits there, prosecutions there, there's no posted price. I think we're going to get something like that toward the end of the year or early next year. But again, it's very difficult to pin down because who knows, maybe the Vatican is going to make a couple thousand tons available out of their vaults. We don't know what they're doing. They're a dark hole.
Describe for the common guy what America is going to look like in a year, or a year and a half, or 6 months, or your not so distant look of what America is going to look like. I mean, we're going to have people going to lose their money in the banks. Are they going to have capital controls here in the U.S. where your account's insured, but you can't have your money. You have $300 today. What's it going to look like?
I think those are some things that will happen and already are here. Again, we're wondering when it's going to happen, when it's happening before our eyes. I have some friends who try to send $25,000 in a bank wire. They got to go through a month of paperwork to prove that it's not pre-tax money, to prove it's not for arms deals, to prove that it's not from narco deals. And these are requirements and paperwork inside the United States. They're forcing delays, and delay is a type of capital control. All right, to get to a main point about the future in the United States economy and the look. The dollar is losing its global reserve status. Now, clown economists in the United States and clown guests on radio shows can say the dollar's going to rule the waves for another 20 years. Well, it doesn't seem to even be ruling the waves in the last 5 years when you factor in the Chinese yuan swap facility. That's a dollar alternative for trade settlement, by the way. That's an intermediate step for gold trade settlement. The dollar's going away. And as the dollar loses, let's just call it the petrodollar standard privilege. You're going to see some important events happen in the next several months where OPEC is overshadowed and eclipsed. I call it the natural gas co-op. And talk about strange bedfellows. How about Iran, Qatar, Israel, Turkmenistan, and Russia? These countries have zero in common, economically or politically, except that they produce vast amounts of natural gas. Some of those countries are involved in liquefied LNG. All right, so you've got this new force that's going to be the powerful entity behind the pipeline build-out. The United States can't even control the Iran-Pakistan pipeline. The Chinese came in and funded that, and they're going to fund an extension to China. All right, so all these different things are happening. I think the petrodollar is going to fade away. Let's face it, King Abdullah is clinically dead. It's now in the news. He's clinically dead. He didn't come out of a back surgery from about 3 months ago. So all these different things are happening, and it's going to lead to the dollar not having its privilege anymore.
And that's going to lead to big inflation.
When you don't have the dollar being accepted in trade, it means the dollar is going to have to compete. And the U.S. dollar cannot compete because it's got third world finance data behind it. Its fundamentals look horrible. Take your favorite third world nation, put the United States next to it on ratios, they're the same. United States is Greece in its ratios. Multiply it by 100 for magnitude and volume. So the United States, which is roughly, let's just say it's 50% imported for supply, if you get a 30% devaluation of the dollar, you suddenly got a 15% inflation surge for prices.
Yeah.
Not only that, but you've got all these different capital controls and interference and regulatory obstacles, and you've got these forced markets where Wall Street holds prices down for our economic benefit. The benefit will have a backlash of shortage. So in the future, I don't know whether it's a year or 2 years, but it's coming. I mean, I remember, 9 years ago, the world looked quite differently when I started this newsletter. Well, 9 years from now, I'm not going to have a newsletter, and the United States is not going to look anything like what it does now. But we're going to have shortages of supply.
Supply like all supplies or supplies of gold and silver?
No, all supplies, economic supply.
Okay.
The United States already doesn't have any gold and silver. their mint demand for silver alone in the United States and Canada is 25 million ounces more than the two countries produce.
What is that going to do for prices of gold and silver? I mean, they've been suppressed for a couple of years. They've been down. Ultimately, I guess they're going up and up significantly.
Well, the big question is, when does COMEX shut down? As long as COMEX is open, you're going to see the price falling. But that's not the real story. The real story has to do with what true price is. True price is what the market determines from an equilibrium. We don't have any equilibrium with gold and silver. We don't have that supply meets demand. We don't have that demand clears supply. We have shortages. I think that in the United States we're going to see tremendous shortages across the board, including gold and silver. Just think food and gasoline, that's where the riots are going to occur. We're going to have rising prices, and that's where you're going to see more public outcry, because they're going to want to see that their pensions or their welfare increases. They're going to want wage demand increases. It's just not going to happen. And that's where you're going to see a lot of the out-of-control chaos and the government stepping in to restore order. And that's why the Homeland Security is locking down all the ammunition and making it very difficult to purchase weapons. We're going to see in the gold and silver market a turnaround, but I really don't think it's going to happen until it's rather obvious to the whole Western world that the COMEX has no gold, so it's going to lose its trading volume. And then it gets ignored. And London ditto. Think of London as not only a trading center, but it's also a big warehouse for the COMEX. The United States is much bigger than England, but London is a giant financial center with huge warehouses. Okay, when the contracts just become irrelevant in the COMEX, that's when you're going to start seeing real demand determine what the price is, because the premiums are going to go out of sight. I think in a couple of years we're going to see $3,000 gold. In a couple of years we're going to see $100 silver. And when the new trade settlement system comes in with a gold structure behind it, and again, the yuan swap facility is weaning the world off the dollar bottle like a baby. The dollar's going to go away for trade. It's already down tremendously. If you look at the volume of international trade settled in dollars, it's down like 20% in the last several years. The euro is important, but the biggest blow that the United States delivered to itself, people say they shot themselves in the foot with the Iran sanctions. No, they shot themselves in the chest. They shot themselves near the heart. And they're bleeding on the ground from the Iran sanctions, because what it did is it accelerated the entire movement to find a dollar alternative in trade. And that has been in progress with the G20. And look to see who's controlling the G20 now. It's China with Russia at their side. The United States cannot push them off the stage because the Russian and Chinese militaries, hey, we can say that we're superior in all these different ways. Russia made a decision in the late 90s. They cannot attain military superiority across the spectrum. So they decided to create one weapon and develop it, and it was the Sunburn missile and the Onyx next generation to it that eclipsed the cruise missile and puts at risk the entire U.S. naval fleet. There's no war in Iran because the United States does not want to lose their fleet in the Mediterranean and Persian Gulf in the first 30 minutes. So the United States dollar is going away. Gold is coming in. Gold trade settlement is going to be the norm. And notice the change. The final point. Notice the change in the name. 2 months ago, they called it the BRICS Development Fund. It was going to fund infrastructure projects like the Nairobi Railroad. They're very smart. They didn't want to call it the Gold Trade Central Bank. But now there's a new name. They don't call it the BRICS Development Fund anymore. They call it the BRICS Bank. Gee, that's because it's got $200 billion in it now. And later it's going to be the processing plant for emerging markets discharging their treasury bonds, converting them to gold. And this BRICS Bank is going to be the recognized central bank for alternative trade settlement. You don't want to settle in the dollar? Use our bank. We can sell you gold trade notes for letters of credit backed by gold. We're getting back to the gold standard. It's going to happen through trade and how it bypasses the U.S. and the West and the British, the Anglo bankers, is that the gold trade settlement is not going to be based in banks. It's not going to be based in Forex. No currency, no SWIFT code. It's going to be based in gold trade settlement with Turkey as an intermediary and a gold trade central bank with gold trade notes as letters of credit. That does not bode well for the United States, where the shortages and the price inflation is going to drive people out of their minds.
Dr. Jim Willie, he is the publisher of the Hat Trick Letter. You can find it on goldenjackass.com. For anybody that wanted to hear a long interview and really get into your head, and I love this. I'm not chiding you. I love this. You're a smart guy. Anybody who wanted a long interview about what's going on, you have done it, sir. Thank you so much for being on USAWatchdog.com.
Always a pleasure, Greg. Thank you.